Welcome everyone to the Get Real Real Estate channel, where we're going to show you 10 real estate investing rules that you should consider before buying a property. But before we get started, we ask you to hit the subscribe button so you can have more access to real information in real estate investing. Let's get started and show you how to make money with real estate by following these 10 real estate investing rules. Rule number 1. The vacancy rule. With the vacancy rule, you figure out what is the need for housing in this area you're looking for to invest before you even buy the property. Because if housing is not in demand in this area, you will have vacancies, which will cost you lost income every month. And as negative signs become larger, you'll be more and more desperate and more prone to rent to anyone, which may lead to a bad tenant who doesn't pay any rent and may damage your property. Or you negotiate an extremely low rent in hopes you could raise the rent in the future, but then they move in forever and now you're stuck. If vacancies are high, simply do not invest in that area. Only invest in areas with low vacancy and increasing population growth so you will always have tenants. Rule number 2 is the 20% rule. The 20% rule focuses on how much you should pay for an investment property so you can make money when you buy. Aiming to pay 20% below fair market value is recommended. While you won't always be able to achieve this, it's essential that you pay below fair market value so you can maximize your potential profit and create a built-in contingency fund, which is mandatory and in certain times like we're experiencing today. When you pay 20% below fair market value, you've created built-in equity, which can protect you from housing market drops. Plus, this built-in equity can be great for refinancing, so you can pull your down payment out and have $0 in your investment. This is not an easy rule to follow, but I never buy a property unless it's way below asking, and we do it all the time, even in high-growth markets, in A-plus markets, so it can be done. Rule number 3 is debt coverage ratio rule. The debt coverage ratio rule is how much you earn from your investment property compared to how much you spend on servicing the debt used to purchase it. Aim to having your operating income be higher than your debt coverage, as you'll pay off the loan faster, giving you access to the equity that you could reinvest. With increased interest rates, this is not easy to do anymore, but it does not mean that you stop buying properties. The best way to do this is to identify the best and highest use for your property. What is needed in your area, and how can you generate more income so you could be cash flow positive, or at least cash flow neutral every month? Rule number 4, loan to value rule. Loan to value refers to the percentage of a loan you receive for a property compared to how valuable it is. You should aim to have this as low as possible, as you'll have lower fees associated with it. You'll generate a larger return on investment with it, especially if you're trying to flip the house. Now, that being said, if you don't have enough money to put into your deal and you have a plan to buy, improve, increase value, and then sell for a profit, or be able to refinance at a low loan-to-value ratio, then do it. There's a lot of creative mortgage products out there ready to finance projects for as little as 2% down. But you need to show them as an investor that you know what you're doing. Rule number 5 is the cash flow rule. The cash flow rule focuses solely on helping you determine whether you can make money with real estate. You'll need to have positive cash flow to achieve this, which means more money coming in from the property than what you spend on it. If you're 100% leveraged or invested in a more expensive area where income does not exceed expenses, once again, you need to focus on a strategy that will provide you with the income you need to be at least cash flow neutral. Negative cash flow is not allowed. It is your job as an investor to create positive cash flow properties. Rule number 6 is the cap rate rule. Although cap rates are mainly used in commercial real estate, you can use them in residential real estate to see if the property will cash flow. The cap rate refers to the ratio between a property's net income and its value. Market-driven percentage is a potential rate of return for a property. A general rule of thumb is the more expensive the property, the lower the cap rate unless the rental income in the area controlled the price. But you should not chase high cap rates, as many cheap markets advertising properties with high cap rates are horrible places to invest and only appear good on paper. In reality, there's very little growth opportunity and the income coming in is not dependable. You may need to interrogate why a specific property earns a certain market cap, otherwise you are chasing paper deals. As long as you can get your property to a 4.2 cap, you should be in a cash flow neutral position. Rule number 7 is the 50% rule for expenses. The 50% rule focuses on spending no more than an average of 50% of the income you generate from your investment property on expenses. If you're renting it out for $2,000 a month, you shouldn't pay more than $1,000 a month in repairs, maintenance, and other fees. While this might not always be possible, it's good to strive for, as your job as an investor, aside from producing income, is monitoring and reducing expenses so you can maximize cash flow. Rule number 8 is the cash-on-cash return rule. One of the more notable real estate investing rules is to focus on your cash-on-cash return, which refers to the return you'll see with your investment. The larger the percentages, the larger your profit will be. But don't be discouraged if your cash-on-cash return in buy, rent, hold appears low, especially if you're investing in a high-growth area. What you really want to pay attention to is the total ROI over a 5-year hold. If your cash flow is all you're focused on, once again, you may be chasing paper deals that are not good long-term investments. Rule number 9 is the unit mix rule. Having the right unit mix in your investment portfolio is essential, especially when units are in one building, such as apartments. Much of this is dictated by where the property is. If it's in an area dense with college students, focus on affordable one-bedroom apartments could be recommended. Rule number 10 is the 1% rule. Now, the 1% rule, sometimes called the 2% rule, dictates that a property should rent for no less than 1% of its value. In doing so, you can better plan out when you'll see a return on investment. While there may be some additional fees and missed rental months, you'll get the investment back in 100 months. You can always speed this up by going for a 1.5% or 2%. Although this is not realistic in many markets that are still great to invest in, it's an excellent benchmark to use and to challenge investors to get creative with creating income in their properties. If you want to make money with real estate, you'll need to keep quite a few things in mind. The various real estate rules for making a profit will be essential. At the same time, you'll need to know what strategies to use, what your risk tolerance is, and much, much more. All that can seem overwhelming. With our PI education, we make real estate investing simple and easy to understand. We work with you throughout the entire process so you feel confident in your decisions. You'll not only know all of the real estate investing rules, but everything else you need to know about the area. What's stopping you from getting in touch and starting your investment journey? We hope this helped, and if you like this video and want more videos like this, show us by giving us a thumbs up and leaving a comment in the link below. And remember, keep it real.